Welcome to JDMBI.com. This is John. This report is for the 10th of November. And well, as we were talking about it, I was mentioning that 50% as the return would be critical for support level holding, particularly as we were seeing the cyan on the DOC here crossing over green. It's usually fairly negative. We saw a pretty sharp drop off of the MBI magenta even as the day was beginning, and it really accelerated. And now dipping below that 33, so that puts added pressure at this 50%, and whether it can hold. And as I was pointing out, the 43.22 would be the likely move down on break of that support level there. A lot of people were claiming this was the credit crisis. It had been building from last week. There was intervention on the Treasury auction there. The 30-year went very poorly. Who is going to be buying up this debt? You've got $1 trillion interest payment every year now, and that's only going to expand. No end in sight as to the deficit spending, and that situation is something we talked about before, and it's going to grow exponentially. And if the Fed has to jump in with the liquidity, and that could throw a lot of turmoil and things. Of course, the market might like that to a degree, but it poses some other broader systemic issues that not necessarily resolved. From an NQ standpoint, it's much stronger still from the 61% range. But you can see the dip down, not quite with MBI white leading, but it's pretty close and in the strong decay right there. But you got a rollover of DOC red, stabilizing a bit at this particular point, but there's the beginning of a dip in the shakeout now. Yes, it's the start of something there. Of course, shakeout's got to return back to a negative for it to be, catastrophic to where it's going to lead to breakdown here towards the lows. But the fact that you saw significant fade off means that while shorts have activated significantly in here, it's not at this particular stage critical, but it's starting to indicate that there was just a lack of steam, and that really became the question of whether or not funds were going to be going into treasuries and that. And in this case, we see that not only that, so it means that it gets people with sideline money, and they're not really going to do anything at this particular stage as they're trying to figure out where things go. So that brought the yield back up slightly, and if that starts to increase again, it's only going to exacerbate the issue. And this gets into the broader issues of the real estate markets and various other conditions that you're starting to see in the U.S. And some people are determining whether or not that's signaling a break of things and whether it's going to accelerate. But you got to remember, this is also that bullish period going into the end of the year, so you got to fight the strong headwind of wanting to see a lot of money pop into things to really be more bullish. So wouldn't be surprised. We've seen this before where there's this back and forth, and then this nothing about the other day was dramatic. I mean, it was a pretty tiny retrace given what we've seen from a positive extreme standpoint. So not overly worried about that one from that standpoint. I think it's still very orderly. And we saw the readings when we look at the 50K, it was pretty clean from when the conversion started. When we look at oil, the significant decline in oil makes a huge difference if it's able to stay this way for a period of time. Of course, you've got to be like this for weeks for it to really start to ease things off, because this really created the early punch of added inflationary pressures. This will ease it off going into later, but it's always much slower coming back down from a price standpoint than it is going up. And the euro holding up surprisingly well given the disaster situation that is the eurozone. And it just depends on if there's a cold winter, and that I think the euro suffers even further, because again, the ease in gas prices should be driving the euro higher, and the fact that it's kind of stalled in that was a reflection of how weak the eurozone was looking from an industrial production and everything else. So that just for all this, again, this is where everyone talks about the demise of the dollar. It's like, well, the euro, the yen, they're going first, so watch those before you worry about where the dollar is in that relationship. And interestingly enough, gold had a little bit of a pop back after filling positive extremes there, but not doing a whole lot at this particular situation. And what was interesting more, though, has been the rally from the cryptos. And as we can see that the filing for ETF capabilities and that BlackRock and that has really created the push that's gone through. Bitcoin faded back on there, and this is interesting because it gave ETH the opportunity to catch up. And as we were talking about the laggard of ETH going in through there, when it comes to evening out that imbalance, this was a necessary kind of move to sort of even things out a bit, and did quite that. Plus, there's a lot of question as to the extra utility that ETH has over Bitcoin from a actual practical standpoint. So when we were talking about it, this was the MBI White that, as the day began, had already popped up, and it was just a matter of that first move of magenta below yellow, and that began the early part of it. There was a brief attempt coming back, but we know that whenever there's that pivot below 25 of the MBI, particularly when we get a DOC spread, as took place right there at the exact same time, and that was just pretty clean throughout most of it. There was a brief move, but again, another pivot below 25, so we expect this to come back down to the lows, and of course that did from that pivot, and the DOC spread create a move towards the zero, and it was fairly clean overall. But you can see still from a positive extreme standpoint, we got as low as here, which literally is just this positive extreme. You still have positive extremes that take us down to 43.20s, and then the next leg on a more sustained one is going all the way back down to that 42. So plenty of room coming off of this rally to fill back in. And the reality of it is, the first you would look at is a 50% move, and that's where we would gauge then from there how much strength there is going into the second half of it. From an intraday chart, you can see it was pretty clean. Also from 5K, pretty straightforward weakness from the MBI magenta that led to the breakdown. Then we started getting MBI white leads even on the pump, and every time there was a fade off of the magenta is when we started with the breakdowns, and that pretty much persisted throughout the day. We're seeing a little bit of stabilization here and a nice pump back up from a post market in Europe, but that pretty much gave it all back once it was on positive extremes, and those were coming back to there, so it's just filled back in place to flatline at this stage. So all in all, not unexpected from our standpoint. The real question was, though, for us, whether or not we were going to see money moving into the market in a strong way, and clearly on the credit situation, it faded off, but I really think that was still part of what needed to be done from a positive extreme, because we know that any healthy rally, you've got to have that pullback in order for it to continue without a significant drawdown. And there's still more positive extremes to go, but it really, we're at that 50%, and that becomes a key level from an institution standpoint now. So I think, interestingly enough, this Friday becomes an interesting play. So we'll see how well the plunge protection is going to be, because if it starts to break that 50, you can see there's a long way to go for selling in that to fill back those positive extremes, and they will get there eventually. It's just a question of how long it takes. That's the long and the short of it for now. As always, though, trade well. Look for me in the Skype chat.